The Federal Reserve is effectively caught in a tightening vice today, between hotter-than-expected inflation data and an escalating energy conflict in the Middle East. Policymakers are increasingly trapped between domestic price pressure and a global supply shock. The Federal Reserve held interest rates steady today, but the real shift is in the updated dot plot. Projections now suggest that rate cuts could be delayed until late 2026 or even 2027. This hawkish tone follows February PPI data, which overshot market expectations across every major consensus number. The Fed's decision is only half of the story. Abroad, the energy conflict hit a new phase today with a direct attack on Iran's South Pars gas field. This marks a critical shift from shipping disruptions to direct hits on production infrastructure, a move that puts other major Gulf assets at risk and fundamentally raises the stakes for global supply stability. The energy shock we're seeing now is behaving differently than the 2022 cycle. Forward guidance frames this as a macro chain reaction, where central banks are unlikely to ease into an oil spike, especially as they maintain the hawkish stance seen here. It creates a difficult vice. Energy prices drive inflation higher while simultaneously suppressing growth. Bob Elliott notes that a 1.5% price hike from oil could be enough to stall real household consumption growth to zero. The underlying risk stems from a major structural shift. The U.S. has transitioned to a savings-driven model, where both households and businesses are now spending more than they earn. In this framework, higher fuel costs act as a direct tax that the economy has almost no cushion to absorb. This lack of a buffer could force a much sharper contraction in demand than what is currently being priced into the market. We're seeing clear evidence that the U.S. consumer has finally reached a pricing breaking point. Eurodollar University highlights a major shift at McDonald's, which is launching a new $3 value menu, a significant reversal after years of aggressive price hikes. This move signals that corporate pricing power is fading as core customers retrench. The pressure is compounded as seasonal tailwinds lose their effect. Danielle DiMartino Booth points out that the typical $360 bump from tax refunds is being entirely swallowed by the recent spike in gas prices. This stress is now moving into the financial sector. The compound is highlighting significant technical breakdowns in lenders like Ally and Capital One, where drawdowns have reached 25 to 30%. Even though the broader indices haven't cracked yet, these credit signals suggest a level of household fragility that may soon weigh on wider corporate earnings. In the tech sector, a historic drawdown in Constellation Software is putting the tech Moat thesis to the test. The Investors Podcast Network reports that the stock is weathering its steepest decline on record, down over 50%, as markets price in fears of AI disruption. But we should look at this through a new frame. Instead of a terminal threat, early evidence of AI deployment suggests these tools can actually drive higher organic growth. We're already seeing functional agents being used to justify new pricing tiers and accelerate feature rollouts. The bull case here is rooted in customer psychology. In mission-critical systems, reliability is far more important than cost. Most enterprise users won't risk an infrastructure that never breaks just to capture modest savings. These high switching costs mean that if incumbents can effectively integrate AI, they may actually strengthen their competitive position rather than lose ground to unproven competitors. Moving to our signal sweep, shipping data reveals a massive reality gap. Despite official reports of a recovery, NANA indicates that volume through the Hormuz Strait is still 98% below normal levels. In commodities, we're seeing a potential peak for inputs. Mizuho recently downgraded fertilizer giant CF Industries, noting that its 27% rally has likely priced in the current supply shocks. Geopolitically, the Hoover Institution now frames the U.S.-Iran conflict as Gulf War II, which has officially entered its 12th day of direct engagement. Looking further ahead, dividendology highlights a key signal for the 2026 tax regime. Married couples will be able to collect up to $131,100 in qualified dividends while maintaining a zero federal tax liability. The critical threshold for upcoming sessions remains the price of oil. The compound suggests that while $78 is the ideal level, a breach of $100 would likely force price readjustments for nearly every product in America. Even with these macro concerns, the market is broadening, as 2/3 of S&P 500 stocks are currently outperforming the index. Historically, the S&P averages a 14% return 1 year after major geopolitical events, showing the market's ability to look past short-term shocks. That wraps up our look at a market caught between the Fed's hawkish hold and a production-level energy war. Moving forward, watch for that $100 oil threshold and the broadening participation we're seeing in the index. For full sources and citations, check the episode description. Subscribe for daily recaps, and we'll see you in the next session.